We are standing at the opening chapter of a new kind of global conflict, not fought with missiles or tanks, but with prices, metals, and monetary power. The era of quiet economic rivalry is over. The price wars have begun. Today, I want to break this moment down into key realities you need to understand. This is the moment the world stops pretending. For decades, the global financial system survived on quiet agreements, polite diplomacy, and unspoken rules. Those rules are now being torn up in public. When China stepped forward and openly signaled its ambition to elevate its currency onto the world stage, no longer as a regional tool, but as a global alternative, it crossed a psychological line that cannot be uncrossed. This was not a policy tweak. This was a declaration that the post-World War II monetary order is no longer sacred, no longer permanent, and no longer unquestioned. Markets felt it immediately, even if headlines tried to soften the language. This was the first open challenge to dollar dominance in a generation. Before we go any further, if this breakdown is hitting home, take a second to subscribe and switch on notifications so you stay ahead of what's coming next. Also, drop a comment below and let me know where in the world you're watching from and what time it is right now. This channel spans the globe, and I always like seeing how far this conversation reaches. Leave your location and local time, and I'll see you in the next one. What makes this moment so dangerous and so historic is not just the ambition itself, but the method. For years, currency challengers relied on promises, trade settlements, and political alignment. That never worked. Trust cannot be printed. China understands this now. Instead of selling ideology, it is signaling substance. It is anchoring credibility to tangible value, to assets that cannot be conjured out of thin air, to the oldest monetary instinct humanity has ever known, hard backing in a world drowning in debt. This is why the move rattles central banks. It forces a comparison they never wanted the public to make. Paper versus weight, promises versus reserves, faith versus physics. Emotionally, this strikes at the core of global confidence. The US dollar has not ruled because it was perfect. It ruled because it was uncontested. That era is ending. Once a challenger openly steps into the arena, the illusion of permanence dies. Investors don't need the challenger to win. They only need to believe the fight is real. And now, undeniably, it is. Currency power is not about exchange rates alone. It is about belief. And belief, once fractured, never fully heals. From a strategic standpoint, this is not reckless bravado. It is calculated timing. The world is over-leveraged. Governments are buried in obligations they can never repay honestly. Central banks are trapped between inflation and collapse. In this environment, the mere suggestion of an alternative reserve framework acts like a stress fracture across the entire financial system. Capital begins to question loyalty. Trade partners begin to hedge. Institutions quietly rebalance. No press conference announces this shift, but flows reveal it. This is how empires lose monetary dominance, not in a single crash, but through a slow migration of trust. The emotional trigger here is fear masked as confidence. Officials will insist nothing has changed. They always do, but insiders know better. When a nation openly challenges the reserve system, it is not seeking cooperation. It is testing resolve. It is asking a single question: who blinks first? And history shows that reserve currencies do not fall because of defeat. They fall because maintaining them becomes too expensive politically, socially, and morally. Once defending the system requires constant intervention, constant narrative control, and constant emergency measures, the endgame has already begun. This is why this moment matters more than most people realize. It is not about China winning tomorrow. It is about the world realizing the dollar is no longer untouchable. Once that realization spreads, every asset, every contract, every savings account is repriced through a new lens of risk. That is how financial eras end, not with chaos first, but with doubt. And doubt, once unleashed, is more powerful than any weapon ever built. This is where the illusion of free markets collapses. When the United States, alongside dozens of allied nations, chose to intervene directly in the pricing of critical minerals, it wasn't acting defensively, it was asserting control. This was not regulation. This was not stabilization. This was a deliberate power move aimed at the foundation of the global economy. By imposing price floors on strategic materials, Washington made one thing unmistakably clear. The era of passive reliance on market forces is over. In a world where resources define power, the United States has decided that prices themselves are now instruments of statecraft. At an expert level, this strategy is both aggressive and revealing. Price floors are not designed to protect consumers. They are designed to protect producers, supply chains, and national leverage. By guaranteeing elevated baseline prices for minerals like silver, copper, and rare earth elements, the U.S. ensures that extraction remains viable, domestic production expands, and allied nations stay economically aligned. This is about locking in supply before scarcity becomes uncontrollable. It is preemptive, it is calculated, and it is a signal to rivals that access to critical inputs will no longer be neutral or automatic. Resources are being fenced off, quietly, legally, and permanently. Emotionally, this move carries a chilling message. Governments do not interfere with prices unless something is wrong beneath the surface. When policymakers abandon the myth of market discovery, it means volatility has reached a level they can no longer tolerate or control. Price floors are admissions of fragility. They tell us that shortages are expected, competition is intensifying, and strategic hoarding is already underway behind closed doors. The public hears stability. Insiders hear preparation. This is what nations do when they anticipate disruption and intend to survive it better than everyone else. From a geopolitical lens, this is economic warfare without uniforms. Controlling prices means controlling who can afford to build, to innovate, to electrify, to defend. It reshapes global manufacturing overnight. Countries without access to subsidized or protected mineral supplies will face higher costs, weaker currencies, and shrinking influence. Meanwhile, those inside the pricing alliance gain insulation from market shocks. This is not cooperation. It is consolidation. The global economy is being split into insiders and outsiders, and the dividing line is not ideology, but access to raw materials at controlled prices. The inflationary consequences are unavoidable and intentional. Price floors do not absorb pressure, they transmit it. When foundational inputs are forced higher, every downstream product inherits that cost. Energy systems, technology, infrastructure, military hardware, everything becomes more expensive. Central banks will claim inflation is easing. Consumers will feel the opposite. This is structural inflation, baked into the system, immune to interest rate theater. And once embedded, it becomes politically irreversible. No government willingly lowers strategic prices in an unstable world. This is the real counterstrike. Instead of confronting currency narratives head-on, the United States is attacking the supply side of the global system, where money becomes reality. Whoever controls the inputs controls the outcome. By anchoring mineral prices above market discovery, Washington is not defending the old order. It is reshaping it to survive the next one. And history is brutally clear on this point. When nations begin fixing the price of what civilizations run on, it is because the future they see is far more unstable than the one they admit publicly. Silver is no longer hiding in the shadows of gold. What was once dismissed as a volatile secondary metal has quietly crossed a threshold that changes everything. When governments, institutions, and defense planners begin paying attention to silver, it signals a fundamental shift in how power is measured. This is not about jewelry or speculative trading. This is about function, necessity, and leverage. Silver has become the connective tissue between the physical economy and the monetary system, and that makes it dangerous, strategic, and impossible to ignore. From an expert standpoint, silver occupies a position no other material can replicate. It is both a monetary relic and a modern industrial linchpin. It conducts electricity better than anything else. It is essential for solar energy, advanced electronics, medical technology, and military systems. Unlike oil or copper, there is no true substitute at scale. That reality transforms silver from a commodity into a bottleneck. And in geopolitics, bottlenecks are pressure points. Whoever controls them doesn't need to fire a shot. They dictate outcomes through scarcity alone. Emotionally, this is where complacency dies. Markets spent decades treating silver as an afterthought, pricing it as if demand were optional and supply were endless. That illusion has collapsed. Governments do not talk about silver openly unless they are already worried about access. Once a metal becomes essential to energy transitions, digital infrastructure, and defense readiness simultaneously, its price is no longer just a number. It becomes a signal of stress, a signal of competition, a signal that the system is tightening. What makes silver uniquely explosive is its dual identity. It sits inside vaults and inside machines. It is hoarded and consumed. Gold can be stored indefinitely. Silver is used up. Every panel, every circuit, every weapon system permanently removes silver from circulation. That means above-ground supply shrinks even as demand accelerates. This is the nightmare scenario for policymakers, a finite, depleting asset that cannot be replaced and cannot be printed. Once this reality becomes visible to markets, repricing is not gradual, it is violent. Strategically, when authorities begin managing or influencing silver pricing, it tells us they no longer trust free markets to allocate it correctly. This is a quiet admission that silver is too important to leave to speculation. History is clear here. Every time a material is pulled into the orbit of national security, it exits the realm of normal commodities. Prices stop reflecting supply and demand alone. They reflect fear, preparation, and control. That is when volatility turns permanent. The emotional trigger for the public is subtle but devastating: loss of optionality. Silver was once something you could ignore. That is no longer true. When silver prices move, they ripple through energy costs, manufacturing margins, and currency confidence. It becomes a mirror reflecting deeper instability. And mirrors are uncomfortable. They show what narratives try to hide. This is why silver is so dangerous to fiat systems. It exposes the gap between paper promises and physical reality. From a voiceover perspective, understand this clearly. Silver is being reclassified in real time. Not with announcements, but with actions: stockpiling, strategic reserves, policy coordination, supply agreements. These are not the behaviors of a market treating silver as expendable. They are the behaviors of a system that knows it is vulnerable, and vulnerability, once recognized, accelerates every defensive instinct at once. This is why silver matters now more than at any point in modern history. It is no longer just a hedge or a trade. It is a stress test, a pressure valve, a warning signal. When silver stops behaving like a commodity and starts behaving like a strategic asset, it tells us the world is preparing for a future where trust is scarce, supply is contested, and money must once again answer to physics. And that future is arriving faster than most people are ready to admit. This is where the consequences become unavoidable. While governments frame price controls and strategic coordination as protection, the real bill is quietly transferred to one group: fiat currency holders. Not tomorrow, not someday, now. The moment price floors are imposed on essential materials, the purchasing power of paper money enters a one-way decline. This is not theory, it is arithmetic. When the base inputs of civilization are forced higher, every currency not anchored to physical constraint absorbs the shock, and fiat currencies absorb it poorly. Emotionally, this is the most brutal phase of the cycle because it is invisible at first. There is no single crash, no headline declaring collapse. Instead, life becomes subtly more expensive, then persistently more expensive, then relentlessly unaffordable. Savings lose meaning. Wages chase prices, but never catch them. The public is told inflation is transitory, manageable, cooling. Yet each trip to the store feels heavier. Each bill feels sharper. This is how monetary decay actually happens. Not with panic, but with exhaustion. From an expert lens, price floors on critical inputs hardwire inflation into the system. This is not demand-driven inflation that can be crushed with interest rates. This is cost-push inflation embedded at the molecular level of the economy. Energy, infrastructure, technology, defense, healthcare, everything depends on metals and materials now being politically supported above market equilibrium. Central banks can raise rates all they want. They cannot print copper, silver, or rare earths. And when money collides with scarcity, money loses. The emotional trigger here is betrayal. Fiat currency is sold to the public as stable, flexible, and safe. Yet its survival depends entirely on trust and restraint, two things governments abandon first in times of stress. When policymakers choose to protect strategic assets instead of purchasing power, they reveal their priority hierarchy. Nations will sacrifice currency value before they sacrifice resource access, every time. History confirms this without exception. This is why fiat holders are always last in line. Sovereign debt will be inflated away. Corporate balance sheets will be restructured. Asset owners will reprice upward. But cash savers absorb the full force of adjustment. Their wealth is diluted quietly, continuously, and legally. Inflation becomes a policy tool, not a failure. And once inflation is normalized as strategy, it is never truly reversed, only rebranded. Psychologically, this environment reshapes behavior. People stop saving and start speculating. Time horizons shrink. Risk tolerance explodes. When holding currency feels like decay, society becomes impatient and reactive. This is how bubbles form. This is how inequality widens. This is how social trust erodes. Fiat systems don't just lose value. They corrode decision-making itself. And governments know this. They accept it because the alternative is admitting structural insolvency. From a voiceover perspective, understand the gravity of this shift. Price floors are not temporary crisis tools. They are admissions that markets no longer clear naturally at politically acceptable levels. Once that line is crossed, intervention becomes permanent. And permanent intervention requires permanent currency expansion. The math cannot be escaped. More money must chase fewer strategically controlled goods. That equation only ends one way. This is the silent endgame of commodity wars. Not tanks, not sanctions, but purchasing power bleed. Fiat currencies are being stretched across a shrinking physical base, and the strain is showing. The public will be told this is resilience. Experts know it is fragility masked by authority. When money must be defended by policy instead of confidence, its expiration date has already been set. In the end, this is the real cost of the price wars. Not volatility, not headlines, but the slow realization that fiat currency is no longer a store of value. It is a melting placeholder in a world re-anchoring to physical reality. And once people feel that truth in their daily lives, belief collapses faster than any system can contain.